All right, what's up, everyone, and welcome back to the channel. Today, we're talking about a story that has absolutely rocked the tech world. For the past few years, a massive dark cloud has been hanging over one of the biggest companies on the planet, Alphabet, the parent company of Google. The US government, the Department of Justice, was trying to do something it hadn't done in decades, break up big tech. And last week, the verdict dropped. The result? Google's stock went on an absolute tear, adding billions to its value in a matter of hours. So, the big question is, why? What just happened? And more importantly, with this monster legal battle seemingly over, how much higher can Alphabet stock actually go? We're going to break down the verdict, dive into the secret AI war that this case was really about, look at the cold hard numbers, and then map out an investment plan. Grab your coffee, settle in. This is a big one. Okay, so let's get right into it. The DOJ sued Google, claiming it was an illegal monopoly in the search market. For years, the nightmare scenario for any Alphabet investor was that a judge would force the company to sell off key parts of its empire. The big ones on the chopping block were the Chrome browser and maybe even parts of the Android operating system. Think about it, that would have been a corporate earthquake. But then, Judge Amit Mehta in Washington, D.C. dropped his 230-page ruling, and to put it mildly, the DOJ got a whole lot less than it wanted. This wasn't the death penalty they were looking for. It was more like a stern lecture and a few new house rules. Let's break down what the judge actually decided in plain English. First, and this is the absolute headline, no forced breakup. The judge flat out rejected the idea of forcing Google to sell Chrome. He called it overly demanding and said the process would be chaotic and risky. This is the single biggest win for Google. Their ecosystem. The very thing that makes them so powerful gets to stay in one piece. Second, the judge did put some new rules in place. He banned Google from signing those exclusive contracts with phone makers like Samsung. You know, the deals that legally prevented Samsung from pre-installing a rival search engine alongside Google Search. Now, phone makers are technically free to offer you Google Search and say DuckDuckGo right out of the box. Sounds like a win for the little guy, right? Well, hold on, because here's the third and most crucial part of the ruling, the multi-billion-dollar loophole. The judge explicitly said Google is still allowed to pay companies like Apple and Mozilla insane amounts of money to be the default search engine on their platforms. Let that sink in. They can't use a contract to block competitors, but they can use a mountain of cash to achieve the same result. Judge Mehta basically said that cutting off these payments, we're talking over $20 billion a year just to Apple, would cause devastating downstream harm to those partners. This is the whole ballgame, folks. The ruling preserved the single most effective tool Google has to maintain its dominance. The market's reaction was instant. As soon as the news hit, Alphabet stock shot up 7% or 8% in after-hours trading. Even Apple's stock got a 3% bump because their massive high-profit Google paycheck was safe. Wall Street had priced in a much harsher punishment. This verdict was seen as a massive get-out-of-jail-free card. To put some numbers on what Google avoided, analysts at Baird value the Chrome browser alone at around $100 billion gone. The deal with Apple is worth over $20 billion a year in revenue sharing. That would have been a catastrophic blow to Google's search traffic and a huge hit to Apple's services division. So, while the judge technically labeled Google an illegal monopolist, the remedy he chose basically reinforces its power. He swapped a legal barrier for a financial one, and guess who has the deepest pockets to win that game? Not Microsoft's Bing, not DuckDuckGo, no one. This is why anti-monopoly advocates are calling the decision a total failure. The judge left Google with all its monopoly power intact. But for investors, it was the sound of the biggest risk imaginable simply vanishing into thin air. Okay, but here's where the story gets really interesting. This case was never just about search. The timing of this verdict is what makes it so critical. The lawsuit started back in 2020 when generative AI was still a lab experiment. The verdict, however, landed in 2025, right in the middle of the most ferocious tech war we've ever seen, the battle for AI supremacy. And this ruling just handed Google its most important fortress in that war. That fortress is the Chrome browser. See, in the age of AI, a browser isn't just a window to the internet anymore. It's becoming the new operating system. It's the central hub where you interact with AI. Think about AI agents that can book an entire trip for you, flights, hotels, rental cars across multiple websites. That's not happening in a search box. It's happening inside the browser. The browser is evolving from a tool for finding information into an environment for doing things. This market is set to explode. We're talking about it growing from around $4.5 billion today to nearly $77 billion by 2034. That's where the value is shifting. And who owns the browser space? Google. Chrome has over 3 billion users and a staggering 68% market share. It is the most dominant piece of software on the planet. By letting Google keep Chrome, the court has given them 3 unbelievable strategic advantages in the AI race. 1. Unmatched distribution. Google can push its Gemini AI model directly and seamlessly to billions of users. No one else has a pipeline like that. 2. The data flywheel. Chrome is a gold mine of user data. It knows what you search for, what you click on, what you buy. That data is the fuel that trains and improves AI models. More Chrome users create more data, which makes Gemini smarter, which attracts more users to Chrome. It's a powerful self-reinforcing loop. 3. Deep integration. Google is already embedding AI deep into Chrome's DNA. This isn't just some plugin. To have a truly powerful AI agent, it needs system-level permissions that only the owner of the browser can provide. If you want proof of how critical this is, just look at the competition. AI upstarts like OpenAI and Perplexity are scrambling to build their own browsers. Why? To escape Google's ecosystem and, crucially, to start collecting their own user data. Here's a fun fact. During the trial, Perplexity actually made a public offer to buy Chrome from Google for $34.5 billion. They knew they had no chance, but it was a signal to the entire market. In the AI war, the browser is the high ground you have to control. The irony here is epic. The DOJ's case was about punishing Google for its past sins in search, but the verdict, by leaving Chrome untouched, has effectively protected Google's primary defense against the AI challengers of the future. If Chrome had been spun off, a company like OpenAI could have bought it and instantly created a rival with the distribution and data to challenge Google head-on. That threat is now off the table. So, a huge legal and strategic victory. But how does this all translate to the bottom line? Let's follow the money. Because this ruling directly protects Alphabet's financial engine room. If you look at Alphabet's latest quarterly earnings, Q2 2025, the picture is crystal clear. The company is an absolute juggernaut. Total revenue hit $96.4 billion, up 14% year over year. The core Google Services division, that's Search, YouTube, Android, brought in $82.5 billion of that and generated over $33 billion in profit. This is the cash cow the verdict just saved. Search itself is still growing like a weed, bringing in $54 billion for the quarter. All those default placement deals are clearly working. But here's the most important part of the financial story, the symbiotic relationship between these divisions. The massive profits from Google services are what fund everything else. Alphabet is planning to spend around $85 billion on capital expenditures this year. That's the money for building the data centers and custom AI chips needed to compete with Microsoft and Amazon. By eliminating the threat of a breakup, the ruling ensures that this internal funding pipeline where the mature, profitable search business pays for the capital-intensive growth businesses remains secure. And one of those growth businesses is now officially firing on all cylinders. Google Cloud. For years, Cloud was the fast-growing but money-losing division. Not anymore. This quarter, it brought in $13.6 billion in revenue, up 32%, and its profit more than doubled to $2.8 billion. This is huge. It marks Alphabet's transition from a company with one profit engine to a company with two, ads and cloud. And guess what's driving that cloud growth? It's AI products. And where does the data and funding for those AI products come from? The core search business. See how it all connects? The antitrust ruling protected the heart of the empire, which in turn ensures the financial and data pipeline to the next growth engine remains wide open. Okay, the dust has settled, the stock has popped. Now comes the hard part. As an investor, what do you do now? Let's lay out the risks, the opportunities, and a clear-eyed look at the stock price. First, let's not get carried away. There are still shadows on the horizon. The celebration over the search case might be ignoring the other massive antitrust lawsuit barreling down the tracks. The big risk is the ad tech case. Google is facing a separate and potentially more dangerous lawsuit targeting its complex digital advertising technology business. In this case, a judge has already ruled that Google has an illegal monopoly. The trial to decide the punishment is scheduled to start on the 22nd of September, and here, the DOJ is again asking for a forced sale of core assets, like its ad exchange. A breakup of the ad tech stack could be far more disruptive to Google's revenue machine than anything from the search case. This is the elephant in the room. Other risks? The EU is always more aggressive with regulations, and competition from AI-native companies is real. Gartner even predicts that traditional search engine volume could drop 25% by 2026 as users shift to AI tools. But the bull case is just as powerful. The biggest catalyst is AI monetization. Google is successfully weaving AI into its core search product, and it's actually driving more user engagement. And as we discussed, Google Cloud is now a certified beast. Its growth and profitability give Alphabet a powerful second act. So, where does that leave the stock? Google has had a monster run, up 35% year to date. After the ruling, it blasted through to new all-time highs above $212. The consensus among Wall Street analysts is a buy with an average price target around $214 and a high target of $240. But here's my take. Despite the huge rally, Alphabet is still one of the more reasonably valued stocks among the Magnificent Seven. The problem is that the market seems entirely focused on the good news from the search verdict and may be underpricing the risk of the ad tech case that's just weeks away. That upcoming trial could be a major volatility event. If the judge orders a breakup of the ad tech business, it could cause a significant pullback in the stock. Therefore, a prudent strategy might be to wait for the smoke to clear. Waiting for the ad tech remedy decision at the end of September could give you a much better entry point if the news is bad, or it could remove the last major overhang if the ruling is also lenient. So, let's wrap this all up. The verdict in the DOJ search case was a landmark moment for Alphabet. It removed the single biggest existential threat to the company, a forced breakup, and dramatically de-risked the stock. The entire investment narrative has now shifted. The question is no longer, will Google be broken up? The question is now, can Google leverage its protected empire to win the AI war? The risk has moved from one of survival to one of execution. For long-term investors, this ruling solidifies Alphabet's position as a core tech holding. The company's financial power and market dominance are now backed by a more certain regulatory landscape in the US. But for tactical investors, all eyes should be on that ad tech trial in late September. It's the last known major risk on the calendar, and its outcome will dictate the stock's trajectory heading into 2026. My final thought is cautious optimism. The path ahead is clearer than it's been in years, but there's still one more dragon to slay. What do you guys think? Is Google unstoppable now, or is the ad tech case going to be the real giant killer? Drop your thoughts in the comments below. As always, if you got value out of this breakdown, hit that like button and subscribe for more deep dives. Thanks for watching, and I'll see you in the next one.